I want you to just stop whatever you're doing for a second and try to picture 1.5 billion people.
It's a ridiculous number.
Right. It's a number so staggeringly large that our brains just aren't really wired to comprehend it. That is roughly the combined populations of North America, South America, and Europe altogether.
Yeah, it's massive.
Now, I want you to imagine holding a deeply intimate, highly detailed file on the financial behavior, the mistakes, the triumphs, and, well, the daily habits of every single one of those 1.5 billion individuals.
Which is a terrifying thought, honestly.
Well, absolutely. And plus, let's just throw in detailed files on 201 million global businesses, just for good measure.
It sounds like the premise of a dystopian sci-fi novel, but it isn't. It's the literal everyday reality of the company we are analyzing today. You're describing the proprietary database of Experian.
Exactly. Welcome to this special edition of our deep dive. Today, our mission is to evaluate whether Experian PLC, which, by the way, trades over the counter under the ticker EXPGY, is a compelling investment opportunity for you.
Right, because we are not just looking at a normal company here. We're looking at an institution that basically functions as the underlying nervous system of global commerce.
Yeah, perfectly said. The core question we're going to explore with you today is this. Does holding the world's financial data automatically translate into a stock that you just must have in your portfolio?
And, to give you a definitive answer, we're grounding our entire analysis on two incredibly rigorous documents. First, we're looking at a highly detailed March 2026 Morningstar analyst report.
A great foundation.
Yeah, and second, we have an extensive executive summary and investment memo written from a very skeptical buy-side perspective. Our job is to basically separate the verified historical facts from all the speculative market forecasts so you can see the true intrinsic value of this organization without the noise.
I love that we are looking at a skeptical buy-side memo because, on the surface, a company with data on 1.5 billion people sounds invincible.
It does.
But having the data is one thing. Monetizing it efficiently, defending it from, aggressive new tech competitors, and surviving a global minefield of privacy regulators, that's an entirely different game.
It really is the defining tension of their business. If we're going to determine a fair value for this stock, we first have to understand the actual mechanics of how they extract cash from that data.
Right.
Experian is universally recognized as one of the big three credit bureaus, right alongside Equifax and TransUnion. But honestly, the term credit bureau feels almost antiquated when you look at how their business model actually operates today.
So let's break that down, because I think a lot of people just assume Experian is this giant, filing cabinet in the sky that banks look at. But they operate in two distinct segments, right? You have the business-to-business side, and then you have the consumer services side.
Yeah, exactly.
So let's start with the B2B side.
Okay, so the business-to-business segment is the historical foundation. It's the engine room. This is where Experian provides those traditional credit reports, complex decision analytics, and fraud prevention services directly to institutions.
We're talking big institutions here.
Oh, massive. We're talking about global lenders, regional banks, auto financiers, and even healthcare providers. If a bank is trying to decide whether to give you a $500,000 mortgage, they don't just flip a coin.
Definitely not.
Right. They pay Experian to access your file and run their proprietary risk assessment algorithms to determine the statistical probability that you will default on that loan.
Okay, so the bank pays a fee for the beta poll. That makes total sense. But then you have this consumer services segment, and this is the stuff we all see advertised on television, right?
Oh, yeah.
Constantly. The free credit scores, the identity theft protection, or those digital marketplaces that recommend a specific rewards credit card based on your profile.
Exactly. Now, a lot of casual observers might look at those two segments and think they're completely disconnected.
Right, because one is selling high-level risk analytics to mega banks, and the other is trying to get, a college student to download an app to check their credit score.
Yeah, but the genius of Experian's model is how these two segments feed off each other.
Okay, let's unpack this for a second, because this seems like the secret sauce. How do you connect selling risk models to Chase or Bank of America with selling a monthly identity protection subscription to me?
Well, it comes down to something we call double dipping on a core asset.
Double dipping.
Yeah, Experian has already spent billions of dollars and decades of time building this massive legacy database of credit files to serve their B2B bank clients. The consumer segment, which currently generates about 28% of their overall firm-wide revenue, allows them to take that exact same data asset and monetize it a second time, but
Oh,
directly for you.
wait, so they build the database for the banks, charge the banks to look at it, and then turn around and charge me a premium subscription to look at my own data.
That is part of it, yes.
Yeah.
But it goes way deeper. They use platforms like Experian Activate to bring millions of consumers into their ecosystem, often using, a free credit score as the lure.
Right, the classic hook.
Exactly. And once you are inside their app, checking your score, they know exactly what kind of financial products you qualify for. So they show you an auto loan or a credit card that you are highly likely to be approved for. If you click that link and take the loan, the lender pays Experian a hefty referral fee.
So they are acting as the matchmaker.
Precisely.
They're monetizing the data on the B2B side when the bank underwrites the loan, and they're monetizing it on the consumer side by generating the lead in the first place. That is an incredibly sticky, closed-loop ecosystem.
It's highly synergistic. But, the geographic breakdown of where this revenue comes from is just as crucial for an investor to understand. Right now, North America is the absolute juggernaut. It accounts for roughly 67% of their total revenue.
I noticed that in the reports. 2/3 of their money comes from the US and Canada. And Experian loves to pitch themselves as this globally diversified data giant.
Well, sure they do.
But if almost 70% of the cash is North American, does that global diversification story really hold water? I mean, are we just looking at a US heavyweight with a few satellite offices abroad?
It is a totally valid critique. But to really understand the global strategy, you have to look at the maturity curves of different economies.
Okay, what do you mean by that?
Well, the United States credit market is highly mature. The vast majority of American adults already have a credit file. Growth in the U.S. is steady, but it's incremental. You're basically fighting Equifax and TransUnion for market share, not necessarily bringing in a massive influx of brand new consumers.
Ah, I see.
So to find long-term structural double-digit growth, Experian has to plant seeds in emerging markets.
Meaning places where the middle class is just starting to formalize their financial lives?
Precisely. And that brings us to Latin America, specifically Brazil. Experian has a dominant, almost unshakable position in Brazil through what used to be their joint venture, Serasa Experian. You have a rapidly growing middle class in Latin America that is just beginning to enter the formalized banking and credit system.
So they're getting in on the ground floor.
Exactly. The ramp-up in an emerging market takes years of infrastructure building, but by establishing themselves as the de facto credit bureau in Brazil today, they are capturing generational growth that will pay dividends for decades.
And it isn't just organic growth either. The sources detail how they're aggressively buying their way into these international markets. For instance, they recently spent $820 million to acquire a company called Ilion in Australia and New Zealand.
Yeah, that acquisition is a perfect example of their capital allocation strategy. They're actively trying to ensure that when a middle class emerges or matures anywhere in the world, Experian owns the toll booth that grades their financial reliability. They're buying localized data inventories to basically bolt onto their global framework.
Speaking of that framework, there is a massive technological shift happening internally at Experian that I want to dissect. The sources spend a lot of time talking about a multi-year cloud migration to a platform they call Ascend.
The Ascend platform, yes.
So what is the actual significance of this? Because, let's be honest, every company says they're moving to the cloud. It usually just sounds like corporate jargon for, we bought an Amazon Web Services subscription.
Right. It's very easy to dismiss as jargon. But for a data broker, it is a fundamental rewiring of the business. Historically, Experian held those 1.5 billion records on legacy on-premise servers, mainframes, essentially.
Big, clunky physical servers.
Exactly. And when data is siloed on physical servers in different countries, running complex global analytics is incredibly slow and extremely expensive. The Ascend platform is their attempt to future-proof the business.
Okay, how so?
Well, moving all of this to a unified cloud environment allows them to integrate diverse data sets, like combining your credit history with your alternative data almost instantly.
So it's about speed and the ability to run heavy artificial intelligence and machine learning models on the entire data set all at once?
Yes, the predictive power goes up immensely. But from an investor standpoint, the most important part of the Ascend migration is the margin expansion.
The cost savings.
Exactly.
Yeah.
Once the heavy lifting of the migration is done, which the reports estimate will start showing real structural cost savings around fiscal year 2027, the cost to maintain and query the data plummets.
If I can try out an analogy here, Experian operates like a massive toll booth on the highway of financial decisions.
I like that.
Right. If you want to buy a house, finance a car, or even just get a postpaid cell phone plan, you have to drive your financial application through their toll booth. And the bank or the telecom company is the one paying the toll to lift the gate.
Yep, that's exactly how it works.
So what they're doing with this Ascend migration is basically tearing down the old physical toll booths with human operators and replacing them with a fully automated, high-speed digital tolling system. It processes cars faster, and it costs a fraction of the price to maintain.
That is exactly right. The toll itself is incredibly cheap for the bank paying it. And we will get into exactly how cheap in a moment. But because millions of cars drive through that gate every single day, the revenue scales massively, while the fixed costs remain relatively flat.
Which naturally begs the question, if this toll booth is so incredibly lucrative, why doesn't someone just pave a bypass road right around them?
Ah, the million-dollar question.
Right. And this brings us to the competitive moat. I want to spend some real time here because Morningstar officially assigns Experian a wide economic moat. In the world of equity analysis, a wide moat rating is sort of the holy grail.
It really is.
It means the analyst believes the company has structural advantages that will protect its profits from competitors for at least the next 20 years.
A wide moat rating is rare, and in Experian's case, it is entirely justified by the sheer gargantuan barriers to entry. Let's do a thought experiment.
Okay, let's do it.
Let's say you and I raise $1 billion in venture capital tomorrow, and we decide we want to start a rival credit bureau to take down Experian. We hire the best software engineers, we rent the best cloud servers, and we build a beautiful user interface. We still have absolutely nothing.
Because we don't have the data. The servers are totally empty.
Right. And where does the data actually come from? This is the critical mechanism you need to understand. Experian does not generate this data themselves.
They don't.
No. They rely on the voluntary reporting of thousands upon thousands of financial institutions. Every month, credit card issuers, auto lenders, and regional credit unions securely package up their customers' payment histories and send them to the bureaus.
Wow. So it's a massive network effect. It's mutually assured benefit. The banks give Experian the data so that Experian can give the banks an accurate picture of the whole market.
Exactly. So if we launch our billion-dollar startup tomorrow, how do we convince Chase, Citibank, and 10,000 local credit unions to suddenly start formatting and sending highly sensitive consumer financial data to us?
We couldn't. I mean, the liability alone.
The liability and compliance costs for a bank to add a new data recipient are enormous. There's zero incentive for a bank to share data with a startup bureau when the big three already cover the entire market perfectly well.
It's the ultimate chicken and egg problem. You can't get the banks as paying customers unless you have the data, but you can't get the data unless the banks voluntarily give it to you. That alone feels like an insurmountable wall.
It really is.
But there's an entirely different layer to this moat in the United States that isn't just about network effects. It is literally mandated by the federal government.
Yeah, and what's fascinating here is the regulatory lock-in they enjoy in the U.S. mortgage market.
Yeah.
Government-sponsored enterprises, specifically Fannie Mae and Freddie Mac, purchase and guarantee the vast majority of residential mortgages in the United States.
Okay.
And to qualify for that backing, Fannie and Freddie dictate the underwriting rules. The golden rule they enforce is the requirement of a tri-merge credit report.
A tri-merge, meaning the mortgage lender is legally required to pull a credit report from all three of the major bureaus, Experian, Equifax, and TransUnion. They can't just pick their favorite one.
Correct. Fannie and Freddie want maximum visibility into the borrower's risk. They know that sometimes maybe a regional bank might report a mispayment to Experian, but they forget to report it to TransUnion.
Right. The data can be fragmented.
Exactly. So by forcing the lender to pull all three, they get a comprehensive, merged view of the risk.
So think about what that means for Experian's pricing power. If a mortgage lender has to use Experian to be compliant with federal mortgage guidelines, Experian doesn't have to compete on price at all.
Pricing goes completely out the window as a competitive dynamic. Let's break down the economics of a home loan to see why. Let's say you're buying a $400,000 house. The cost for the lender to pull a comprehensive credit report from Experian is generally measured in basis points. A basis point is 1/100th of a percent. The cost of the report might be 1 or 2 basis points of the loan amount. We're talking about maybe $40 to $80 on a $400,000 transaction.
That's nothing. It's a literal rounding error for the bank.
It is negligible for the bank. But when you multiply that $40 by millions of mortgage originations every year, It forms a massive, incredibly sticky, recurring revenue stream for Experian.
Lenders just aren't going to shop around to try and save $5 on a credit pull when a $400,000 asset is on the line.
Exactly, especially when the government mandates they use the big three anyway.
Now, I did see a note in the sources about a potential threat to this.
Yeah.
There's been an industry lobbying push to move to a buy-merge system. The idea is that lenders would only have to pull reports from 2 bureaus instead of 3.
Right, which would theoretically introduce competition because the bureaus would have to fight to not be the odd one out.
Exactly. How serious is that threat?
Well, that was a significant concern for investors recently. However, the investment memo we're reviewing indicates that this push for a buy merge has essentially stalled out in Washington.
Oh, really?
Yeah, there appears to be broad bipartisan political support with specific emphasis from the GOP for keeping the tri-merge requirement in place. The political appetite for reducing risk visibility in the housing market, especially post-2008, is basically zero.
That makes sense. Nobody wants to be the politician who watered down mortgage safety checks.
Exactly. So for the foreseeable future, that regulatory moat seems incredibly durable.
Okay, so the core traditional credit moat is protected by network effects and government mandates. But, the financial world is evolving rapidly. Traditional credit data, meaning do you pay your Visa bill on time, isn't the only way to judge someone anymore.
Roughly not.
And Experian seems to realize this, and the sources point out that they operate a bit differently from Equifax and TransUnion when it comes to technology. They actually like to build their own fintech or acquire highly targeted data firms.
Right. Yeah, this raises an important question about how you defend a legacy data moat in the 21st century. Experian knows that if they only rely on traditional credit card and auto loan data, they leave themselves very vulnerable to fintech startups that use alternative data.
So they decided to capture the alternative data themselves.
Exactly. This is the genesis of platforms like Experian Boost.
I see the commercials for Experian Boost constantly. The pitch is basically, connect your bank account and we will instantly raise your credit score by giving you credit for paying your Netflix bill, your electric bill, or your telecom bill.
Yeah, it's marketed as a consumer empowerment tool, and it really does help people with thin credit files. But from a corporate strategy perspective, Experian Boost is a masterstroke of data harvesting.
Wow, I never thought about it like that.
By getting you to voluntarily connect your bank account, Experian bypasses the traditional lenders entirely. They are directly ingesting consumer-permissioned alternative data.
And they are taking that raw bank account data and building new products with it. The memo actually mentions a new cash flow score.
Oh, the cash flow score is fascinating.
Tell me about it.
Instead of just looking at whether you missed a payment 3 years ago, it utilizes open banking protocols to look at the actual liquidity in your checking account today. How much cash is coming in from your employer? How much is going out to rent and groceries?
That is so much more relevant to whether I can pay a loan next month.
Absolutely. The sources report that adding this cash flow score into their underwriting models boosts default prediction accuracy by 25% over legacy credit scores alone. That is a massive leap in analytical power.
And when they can't build it internally, they just buy the data. The acquisitions mentioned in the report are really targeted. They bought TapPad for cross-device marketing data. They bought ClearSale to dominate e-commerce fraud in Brazil.
Very strategic moves.
But the one that really stopped me in my tracks was an acquisition called NeuroID.
Ah, yes. NeuroID is the perfect example of where the future of data brokering is heading. It is a behavioral biometrics company.
Let's explain what that actually means because it sounds incredibly invasive. Behavioral biometrics, they aren't just looking at the information you type into a loan application, they're analyzing how you type it.
Exactly. When you are filling out an online application for a credit card, NeuroID's software is running in the background. It actually measures your keystroke dynamics.
That's wild.
Are you hesitating before typing your own social security number? No normal person hesitates on their own social. Are you copying and pasting data into the form at inhuman speeds? That indicates you might be a fraudster bot.
Wow.
So Experian is buying these hyper-niche data sets so that their fraud prevention algorithms become virtually impossible for competitors to replicate.
Okay, I hear all of this. The tri-merge, the boost data, the keystroke monitoring. But I have to push back on this unassailable moat narrative.
Okay, let's hear it.
I want you to project 5 or 10 years down the road. Artificial intelligence is accelerating at an unbelievable pace. If I am a slick new fintech lender, and I build an AI that can perfectly predict loan defaults just by looking at someone's Venmo history, their direct deposits, and maybe their internet browsing habits.
Right.
Couldn't the traditional three-digit FICO score and the Experian credit file become completely obsolete? I mean, if an algorithm can figure out I'm a safe bet without needing to know my 10-year history of paying a MasterCard, why does the bank need to pay Experian's toll booth at all?
It is the single biggest existential threat to their business model. And the analysts who wrote these sources absolutely acknowledge this risk. Fintechs and AI-native competitors are nibbling at the edges, specifically in unsecured personal lending and buy now, pay later spaces.
So the threat is real.
It is. But here is the defense, and it really comes down to scale and historical context. A startup AI might perfectly understand your cash flow for the last 6 months, but Experian knows your repayment behavior across multiple macroeconomic cycles.
Ah, I see.
They know how you behaved during the 2020 pandemic shock. They know how you handled inflation in 2023. The predictive power of a decade of historical breadth across mortgages, auto loans, and student debt is still unmatched by a 6-month snapshot of checking account data.
So the startup might be faster, but Experian has the deep institutional memory.
Precisely. Will the moat narrow over time as alternative data proliferates? Yes, that is highly likely. But will it evaporate overnight? Almost certainly not, largely because of the regulatory safety nets and the extreme risk aversion of the massive banking institutions that make up Experian's core client base.
Right. Banks do not like to experiment with unproven underwriting models when billions of dollars are at stake.
Exactly.
Fair enough. A wide moat, institutional memory, and a sticky customer base make for a great story in a business textbook. But as an investor, you can't buy a story. You need to see how that narrative translates into actual cash flow, profitability, and valuation.
You need the numbers.
Exactly. So let's look at the numbers that actually matter. Let's dive into their financial performance.
The financials presented in the Morningstar report and the Buy-Side Memo are, frankly, remarkably robust. If we look at their fiscal year 2025 results, Experian posted total revenue of $7.52 billion. That represents a 6% increase year over year.
Okay, saw it.
And if you strip out the noise of currency fluctuations and acquisitions, their organic growth was actually around 7%.
So steady, mid-single-digit growth, and their profitability is expanding alongside that revenue. The report notes that their benchmark EBIT margins, that's earnings before interest and taxes, widened by about 50 basis points to 28.1%.
An EBIT margin of 28% is incredibly healthy. But the statistic that should absolutely jump off the page for any investor analyzing this company is their cash conversion rate.
Yeah, let's talk about that.
The sources note that approximately 97% of Experian's EBIT turns directly into operating cash flow. In hard numbers, they generated roughly $1.7 billion in adjusted free cash flow.
I want to stop right there and explain that mechanism for the listener. What does a 97% cash conversion rate actually mean, and why is it so rare?
Sure. Think about a traditional manufacturing company, like an automaker. If they report $1 billion in profit on their income statement, they don't actually have $1 billion in cash sitting in the bank to give to shareholders.
Right.
They have to constantly take those profits and reinvest them into building new factories, buying steel, or upgrading assembly lines just to maintain their business. That is called capital expenditure.
So the profit gets trapped in physical assets.
Exactly. But Experian is a data business. Once the core database infrastructure is built, the capital-light nature of their business takes over. They aren't building physical factories. Selling a digital credit file 1 million times costs virtually nothing in terms of raw materials.
That makes total sense.
Therefore, almost every single dollar of accounting profit they declare converts directly into cold, hard cash in the bank. That is what drives that 97% cash conversion. It gives management an enormous war chest to play with.
So they are essentially printing cash. Let's look at how the stock market is valuing that cash printing machine. As of the writing of these reports in March 2026, the stock is trading around $37.36.
Right.
However, Morningstar assigns Experian a fair value estimate of $55. That implies a massive potential upside.
The executive summary goes even deeper on this. They provide a detailed discounted cash flow analysis, or DCF, to try and pinpoint the intrinsic value of the company under different future scenarios.
And for listeners who might not build financial models every day, a DCF basically tries to estimate all the future cash the company will ever generate and then discounts it back to what that cash is worth in today's dollars.
Perfectly said.
And what did their modeling show?
They modeled 3 distinct scenarios. In their bear case, assuming inflation stays high, loan growth slows to a crawl, and their cost of capital rises,
Hmm.
they calculate the stock is fundamentally worth $25 to $30.
Okay.
In their base case, assuming steady mid-single-digit revenue growth and stable operating margins, they arrive at a value of $40 to $42.
And the bull case.
Finally, in their bull case, assuming continued strong consumer growth and massive cost-cutting success from the Ascend cloud migration, they align perfectly with Morningstar at a $54 to $55 valuation.
So what does this all mean? I want to look at that base case. If the highly detailed skeptical buy-side DCF is telling us the intrinsic value is roughly $40 to $42 and the stock is sitting at $37 today, aren't we just looking at a company that is essentially fairly valued?
That's a fair question.
I mean, despite Morningstar shouting from the rooftops about a $55 price target, a $3 spread on a base case doesn't sound like a screaming bargain to me. It sounds adequately priced.
You are reading the tea leaves correctly there. To understand why it's priced where it is, we need to translate the valuation multiples the market is applying to Experian. The report notes that Experian is trading at an enterprise value to revenue multiple of roughly 4.5 times and an enterprise value to EBITDA multiple of about 12 to 13 times.
Okay, EV to EBITDA of 12x. Let's ground that concept. What does a 12x multiple imply about how Wall Street views this company?
Think of the EBITDA multiple as a rough proxy for a payback period. If you bought the entire company today for its enterprise value, it would take about 12 years of its current cash earnings to pay you back.
Got it.
If you look at a hypergrowth artificial intelligence company like NVIDIA, the market might assign them a 40x or 50x multiple because investors expect their earnings to double or triple in the coming years. Conversely, a dying legacy business might trade at a 4x multiple because investors think the earnings will disappear soon.
So a 12x to 13x multiple puts Experian right in the middle of the road.
Exactly. And more importantly, how does that compare to their direct competitors? It is practically identical. Equifax and TransUnion trade at very similar multiples.
How interesting.
What this tells us is that the broader stock market is pricing Experian exactly for what it is, a highly stable, highly profitable member of a mature oligopoly. The market is not pricing them like a disruptive tech stock. The market sees a reliable single-digit growth engine and prices it at a perfectly reasonable 12x multiple.
But here is where the plot thickens. The market might think the stock is fairly valued at $37, but Experian's management team seems to violently disagree.
Oh, they absolutely do.
In January 2026, the board of directors, led by CEO Brian Cassin, authorized a massive $1 billion share buyback program.
This is a phenomenal signal for investors to pay close attention to. Capital allocation is arguably the most important job of a CEO. Historically, Experian's management has taken all that massive free cash flow we talked about and relentlessly reinvested it into the business.
Right. They bought TapPad, they bought ClearSale, they expanded into Australia.
They prioritized organic research and development and mergers and acquisitions.
So to pivot suddenly, pump the brakes on the M&A and spend $1 billion just buying up their own stock.
It is a dramatic, intentional shift in capital allocation.
Huh.
When a company buys back its own stock, it reduces the total number of shares in existence, which makes every remaining share more valuable.
Right.
It tells you that the people who know the company's internal proprietary financial projections better than anyone else in the world, the board and the CEO, believe that buying Experian stock at $37 is a better, safer return on investment than going out and buying another fintech startup.
That's a strong statement.
It signals intense internal confidence that the medium-term outlook is incredibly strong and that they fundamentally view the market's $37 price tag as deeply undervalued.
That confidence makes sense, especially when you factor in the margin expansion we discussed earlier. If this Ascend cloud migration actually generates the deep structural cost savings they are promising starting in 2027, and their high-margin consumer subscriptions keep rising, could we see those operating margins push past 28% and up into the low 30s?
That margin expansion is precisely what is baked into the $55 bull case scenario. If they can successfully extract more revenue per user in the consumer segment while simultaneously lowering their IT infrastructure costs via the cloud, that operating leverage is phenomenal.
Like compound.
Exactly. A 2% increase in revenue combined with a 2% decrease in costs doesn't just add up. It multiplies on the bottom line, driving earnings per share up significantly.
Okay, so we've established that the internal financial engine of Experian looks rock solid. They have a wide, legally protected moat. They are generating billions in cash, and management is literally betting $1 billion that the stock will go up.
Yep, the internal picture is great.
But Experian doesn't exist in a vacuum. They don't operate on a spreadsheet. They are deeply, inherently tethered to the health of the global economy. So we need to talk about the macroeconomic headwinds. Let's look at the economy's seesaw.
Experience fortunes are incredibly sensitive to the volume of credit applications. At the end of the day, it is a volume game. When the economy is booming, consumer confidence is high, people decide it's a great time to buy a new house, finance a new car, or open a new travel rewards credit card.
And every single one of those actions requires a bank or a lender to pull a credit report.
And every single pull means a toll is paid to Experian.
But the economy isn't always booming. The reports we are analyzing highlight some severe current headwinds. Higher mortgage rates, driven by a rising 10-year Treasury yield in the U.S., alongside a very soft, stagnant housing market in the U.K., have severely depressed loan originations.
They have. People simply aren't applying for mortgages at the staggering rate they were a few years ago when rates were at rock bottom.
Logically, if the volume of mortgage applications plummets, you would expect Experian's mortgage revenue to be cratering right alongside the housing market. But if we connect this to the bigger picture, the data shows something completely counterintuitive.
It really does.
Despite overall loan originations dropping, Experian's mortgage-related revenue actually grew by an astounding 46% to 71% in recent quarters.
That's the part that catches everyone off guard.
Wait, we need to stop and really look at this. How is that mathematically possible? If drastically fewer people are applying for home loans, how is Experian making 70% more money off the mortgage sector?
Two words: pricing power. Or, more accurately in this specific case, FICO's pricing power. This is a brilliant dynamic to unpack.
Okay, explain FICO's role here.
FICO, or the Fair Isaac Corporation, is the company that creates the actual three-digit credit score algorithm. Experian provides the raw data file, but FICO provides the mathematical score that the banks rely on.
Right.
Recently, FICO pushed through massive, unprecedented price increases. We are talking about roughly a 40% price hike for calendar year 2025 alone.
FICO raised their prices by 40% in 1 year.
Yes. Because FICO scores are functionally essential for mortgages, and the bureaus like Experian are the delivery mechanism for those scores, this price increase trickled down through the entire system.
I see.
FICO charges Experian more, Experian passes that massive cost increase directly onto the lender, and the lender passes it on to the consumer in the closing costs. This massive inflation in the cost per transaction resulted in massively inflated revenue for Experian, even on a much smaller number of total transactions.
Okay, so even with fewer cars driving on the highway because of the bad economy, the toll at the toll booth went up so drastically that Experian is making significantly more money overall. It's acting like a financial shock absorber for their balance sheet.
That's exactly what it's doing.
But I have to ask the obvious question. Is this a permanent solution? Masking a fundamental decline in actual housing volume with a 40% price hike feels like a corporate sugar high. What happens when FICO simply can't raise prices anymore without triggering a revolt and housing volume stays flat?
It is a critical, glaring vulnerability. Price hikes of that magnitude are absolutely not sustainable year over year. Eventually, you hit an elasticity ceiling. The consumer or the lender pushes back, or regulators step in.
Right, there's a limit.
If the actual volume of mortgage applications doesn't organically recover by the time this pricing leverage is exhausted, that outsized 70% mortgage revenue growth will hit a brick wall and potentially reverse.
That is a major cyclical risk. But Experian's business is much broader than just residential mortgages. How does the rest of the company perform when the broader economy goes south? What happens in a true recession?
This is where the sheer breadth of their diversification really shines. Over the last decade, Experian has built a surprisingly counter-cyclical business model to hedge against these exact downturns.
Counter-cyclical. So they do well when things are bad.
In certain segments, yes. Obviously, in a recession, banks tighten their lending standards and overall loan origination pulls drop. But what else happens in a recession?
People lose their jobs. Defaults rise, and unfortunately, financial fraud attempts usually skyrocket as people get desperate.
Exactly. So while their loan origination revenue drops, their B2B clients suddenly need massive amounts of Experian's fraud detection software, their portfolio stress testing analytics, and their debt collection services.
Oh, because the banks need Experian to figure out which of their current customers are about to default.
Precisely. They shift from predicting good loans to mitigating bad ones.
And what about the consumer segment during a recession?
It follows a similar counter-cyclical pattern. When unemployment rises and household budgets tighten, people become intensely, almost obsessively focused on their financial health. You see increased demand for Experian's consumer credit repair tools, their premium identity monitoring subscriptions, and their financial educational products.
So the mix of what they sell shifts dramatically, but the fundamental demand for their data ecosystem remains robust.
Exactly. The resilience is impressive. The Morningstar report even quantifies this. They note that in a severe macroeconomic downturn, Experian's organic growth might drop from their historical baseline of 7% down to mid-single digits. But the company still targets about 10% cash earnings per share growth over the entire economic cycle, regardless of recessions.
It is a highly defensive posture. However, you can't ignore the currency risks that come with a global footprint either.
That's true.
Because Experian reports its financials in US dollars but generates significant revenue in Brazilian reals, British pounds, and Australian dollars, a very strong US dollar acts as an automatic headwind.
Yeah, foreign exchange is always a wild card.
When they convert those foreign profits back into strong dollars, the numbers shrink. The report noted a 1 to 2% drag on total growth simply due to negative foreign exchange rates in fiscal year 25. It is a minor scrape in the grand scheme of things, but it constantly chips away at their headline numbers.
It does. It's a friction cost of being a global giant.
Okay, so we've looked at the economic risks, a housing slowdown masked by price hikes, and foreign exchange drags. They are real, but they seem manageable for a company of this size. But there is an entirely different category of risk hanging over this company that could be far more sudden and far more damaging than a dip in housing starts.
The regulatory landscape.
Yes, I am talking about the kind of risk that comes with a judge's gavel and a government subpoena. Let's look at the regulatory, privacy, and litigation risks. For me, this is the real bear case.
And it is a formidable bear case. We have to draw a distinction here between a credit bureau and a traditional bank.
What's the distinction?
Well, if a massively systemically important regional bank gets into severe liquidity trouble, history shows us that there is often deposit insurance, federal loan windows, or outright government bailouts waiting to catch them.
Too big to fail.
Exactly. But if a credit bureau gets into trouble, there is no safety net. Any punitive fines, any massive class action settlements, or any required structural changes to their business processes, that money comes directly, dollar for dollar, out of shareholder pockets.
And the regulatory hounds are already at the door, teeth bared. In January 2025, the U.S. Consumer Financial Protection Bureau, the CFPB, actually sued Experian. And the allegations in this lawsuit are brutal.
They strike at the core of consumer trust. The CFPB alleges that Experian ran what they call sham dispute investigations.
Let's explain the mechanics of a dispute, because anyone listening to this has probably had to do it. You pull your credit report, you see a delinquent account that isn't yours, and you click dispute. What is supposed to happen, and what is the CFPB alleging Experian actually did?
Legally, under the Fair Credit Reporting Act, when you dispute an item, Experian is required to conduct a reasonable investigation. Historically, this involves an automated system called eOscar, where the dispute is boiled down to a 3-digit code and sent back to the bank that reported it.
Okay, an automated system.
The CFPB's lawsuit alleges that Experian essentially rubber-stamped these disputes without proper investigation. And even worse, improperly reinserted errors back into people's files after they had been removed without notifying the consumer.
Experian firmly denies any wrongdoing, of course, and the case is still actively litigating in the courts. But from an investment perspective, how do we price that risk?
Even if this specific lawsuit doesn't result in an immediate, catastrophic, headline-grabbing fine, it creates a massive, lingering overhang of operational uncertainty. The CFPB has been highly aggressive and highly critical of the massive power wielded by the credit bureau.
So it's not just a fine, it's the cost of doing business.
Exactly.
Yeah.
If the CFPB wins this suit or forces a sweeping settlement, it won't just be a financial penalty. It could compel Experian to completely overhaul how they handle consumer disputes. They might have to hire thousands of human analysts instead of relying on automated software.
Oh, wow.
That would permanently, drastically increase their operational costs and compress those beautiful 28% margins we talked about earlier.
Here's where it gets really interesting, though. The United States is not the only regulatory battleground. Experian's global ambitions mean they have to fight global regulators. Over in Europe, in October 2025, Experian was hit with a €2.7 million fine under the GDPR by a Dutch privacy regulator.
Yeah, the Dutch fine is very telling.
And the specific reason for this fine strikes at the very heart of Experian's entire future growth strategy.
It perfectly illustrates the core unavoidable tension in their business model today. We spent a lot of time earlier discussing how Experian desperately wants to gather alternative data to improve their analytics and defend their moat against AI startups.
Right, the telecom bills, the utility bills.
Well, in the Netherlands, Experian offered a specialized credit rating service that actively scraped data from public sources and, crucially, telecom records to assess credit risk.
Why telecom records? Why do they care if I pay my Vodafone bill?
Because it helps them score thin-file consumers, immigrants, young people, or folks who don't use traditional credit cards. If you always pay your mobile phone bill on time, Experian wants to use that data to prove to a bank that you are trustworthy for a loan. It is fundamentally an effort to expand financial inclusion.
But the European regulators did not see it as inclusion. Under the General Data Protection Regulation, GDPR, the Dutch regulator essentially said, you absolutely cannot harvest personal telecom data and sell it for corporate credit profiling without explicit, informed consumer consent. They shut the entire program down and fined them.
And that is the crux of the issue. A 2.7 million euro fine might seem like an absolute rounding error for a company generating $7.5 billion in revenue. But it is not just a financial speeding ticket. It is a fundamental warning shot across the bow of the entire industry.
The regulators are waking up.
Global privacy regulators are actively, aggressively trying to restrict exactly how companies like Experian collect, aggregate, and sell non-traditional consumer data.
If Europe creates a legal blueprint for severely restricting alternative data collection, and powerful states like California follow suit with laws like the CCPA, Experian's ability to innovate and expand its data moat is severely, permanently handicapped. They will be stuck relying purely on legacy credit data.
Exactly. The regulatory environment is shifting from how do we ensure data is accurate to should these companies even have this data in the first place?
Right.
And layered on top of all of this regulatory scrutiny is the constant lingering ghost of cybersecurity. You have the infamous 2017 Equifax data breach, where the highly sensitive personal data of nearly 150 million Americans was stolen due to a patched server vulnerability. The industry has a horrifying history of these breaches.
And the legal landscape surrounding data breaches is getting substantially tougher. The sources mention a Supreme Court case, Spoko v. Robbins, which actually raised the liability threshold for technical breaches of the Fair Credit Reporting Act.
The litigation and cybersecurity risk is a constant low-level hum. Experian is managing a massive, lucrative target. State-sponsored hackers and criminal syndicates are relentlessly probing their defenses every single minute of every day.
It's a constant battle.
If hackers were to deeply penetrate the new Ascend cloud platform, the reputational and financial damage would be truly catastrophic. The regulatory fines are one thing. The loss of trust from the thousands of banks that voluntarily provide the data would trigger an existential crisis for the firm.
So, as an investor, you really have to weigh these two realities. On one hand, you have an entrenched, legally mandated toll booth that prints billions of dollars in free cash flow. On the other hand, the government is threatening to fine the toll booth operator. European privacy laws are restricting what kind of cars can even drive through the toll booth, and sophisticated hackers are constantly trying to blow the toll booth up entirely.
That is the ultimate risk premium you take on when you choose to invest in a global data broker in the modern era. You are not just betting on their financial metrics. You're placing a high-stakes bet that their legal compliance teams and their cybersecurity architects are just as competent and innovative as their data scientists.
It is time to bring all these complex, intertwining threads together and answer our initial question for you, the listener. Based on this exhaustive analysis of the Morningstar and buy-side reports, is Experian plc a compelling investment opportunity? Let's recap the terrain we've covered today without just rehashing the numbers.
First, we established that Experian possesses an almost irreplaceable world-class data asset. They have a wide competitive moat that is literally legally protected in the lucrative U.S. mortgage market by Fannie Mae's tri-emerge requirements. Furthermore, they are not resting on their laurels. They are expanding aggressively and strategically into high-growth, emerging markets like Brazil to secure the next generation of consumers.
Second, the internal financial engine is incredibly healthy. They boast expanding operating margins driven by a shift to the cloud, an unbelievable 97% cash conversion rate that floods the balance sheet with capital, and that new $1 billion share buyback program is a massive flashing neon sign that the executive suite believes the stock is currently undervalued by the broader market.
But third, we must weigh that robust financial picture against the medium-term structural risks. They are highly sensitive to macroeconomic loan volumes. They are currently heavily reliant on unsustainable vendor pricing power, like the massive FICO hikes. And they face increasingly aggressive, highly coordinated privacy regulators in both the US and Europe who fundamentally want to control and restrict how human data is monetized.
The analyst consensus ultimately leans toward a moderate buy, targeting a fair value around $50 to $55 a share, but it requires patience to let the Ascend cloud migration and new alternative data products fully materialize in the earnings reports.
It's not a get-rich-quick stock. It's a long-term compounding play.
Which leaves us with one final provocative thought for you to mull over as we wrap up this deep dive. Throughout this entire hour, we have been valuing Experian based on its absolute dominance in the traditional retrospective credit scoring system. They are the masters of knowing exactly what you did in the past, but we are rapidly entering the age of generative artificial intelligence and predictive modeling.
And as artificial intelligence becomes vastly superior at predicting future human behavior, potentially bypassing traditional credit histories entirely to look at real-time, non-traditional data streams.
Will the massive, deeply entrenched legacy databases of the Big Three remain the ultimate, undeniable source of financial truth? Or will they eventually be outsmarted, outpredicted, and outmaneuvered by a lean AI-native startup operating out of a garage, a startup that doesn't need to know your 10-year history with a MasterCard to know exactly how reliable you are today?
It is the ultimate question of legacy infrastructure versus disruptive innovation. And for Experian, the clock is ticking.
When we started this episode, we talked about picturing 1.5 billion individual human lives reduced to rows of data. What we've discovered is that evaluating the company holding that data is not a simple math equation. You are looking at the sprawling, incredibly complex, highly regulated nervous system of the global economy. It is murky, it is fraught with risk, but it is endlessly fascinating. Thank you for joining us on this deep dive.